Welcome to the Kindle Report, where I share my 41 years of experience to help you manage your portfolios and protect your wealth. Remember to subscribe, like, and share these videos. As we get into tonight's video and looking back on last week, it was quite the disastrous week overall. The S&P was down 1.9%, NASDAQ down 0.3%, and the Russell led the way down at 4.2%. Now, we look at the year-to-date, S&P up 10.9%, NASDAQ up 8.9%, and the Russell up 13.3%. All the markets are starting to normalize and almost are returning about the same across the board. As we look at the sectors last week, we saw a lot of backtracking. Financials down 6.2%, materials down 6.3%, energy down 5.2%, and industrials down 3.8%. We saw the 10-year backtrack as inflation expectations went down. This also affected the forward-looking expectations for the financials. That's why they were down so hard. The 10-year finished at 1.45. I'll talk a little bit more about the interest rate outlook later in this video, but for now we're looking at inflation expectations seem to be muted. We do have some numbers coming out this week I'll discuss in a minute that is likely to affect the inflation outlook again. We did see a lot of commodities backtrack, a lot of things happen last week. We saw lumber down about 40+% off of its highs. It's up 223% overall, so it's still substantially elevated, and I do expect to see a lot of these commodities in the inflation trade stabilize at much higher levels than where they started. I don't see them going all the way back to square one. There's still a lot of supply issues and other things out there that are affecting those markets. But as we look forward to this week, as far as economics go, we are going to see on Tuesday existing home sales expected to show 5.65 million. I'm expecting all these home numbers to miss this week. I see the supply constraints starting to come in play. It isn't necessarily a negative. I just don't think there's enough supply out there. New home sales expected 860,000. That's also a supply issue. As we get into Thursday, we'll have the claims expected to show 393. This number came in higher last week, and I believe as we go forward, we're going to see the employment numbers start to struggle. We're expecting 393 this week. I wouldn't be surprised to see it come in at 450 plus. And these metrics are going to start to paint a much different picture than what Powell was talking about last week. Also, we got the continuing claims at 3.51. I expect to see them increase as well. We have GDP, the third estimate coming out, expected to show 6.4%. That might come in a little weaker once they adjust these numbers a little bit. I think we're starting to see some of the flatness. The other number that people will be watching as far as the GDP comes out is the GDP deflator. That's expected to show a 4.3% increase. If that comes in a little hotter, that's going to keep pushing on that inflation story that's out there. And I expect to see some of this stuff come back into play this week. On Friday, we have personal income expected to come in minus 2.2, personal spending up 0.4. We saw these numbers the same way last month, and I don't really see anything material coming out of that. We also have the PCE coming out, which is the indicator that the Fed says they watch closely. That's expected to show a 0.6 number. If that comes in hotter than that, 0.8 or more, that could be a negative. And once again, that inflation story is going to continue to be out there no matter what we do. While I won't cover the 10-year tonight, I do want to mention I think it will recover back to 1.52, 1.54, and the extreme on the downside is likely to be between 1.42, 1.38. It all depends on how some of these numbers that I talked about come out. As we look back on the Fed meeting last week, Powell did make some interesting references. As you know, I put a video out on Thursday talking about how he revealed they really don't have any plan at all, nor do they actually understand what's going on. I'm going to play a clip here in a minute with Ron Paul interviewing Ben Bernanke back in 2010. And this is an interesting conversation because I think this is going to be important to understand because we have a similar thing going on right now, but much more expanded. Let's go ahead and watch the clip, and I'll discuss this after we've watched this.
Can you give me a rather quick answer on this? Do you have any idea what percentage the base should shrink or might shrink, or is that something that you don't even want to address?
No, I think we would like to bring the balance sheet back to something consistent with where it was before the crisis, which means enough to accommodate Americans' demand for currency, plus a modest amount of reserves in the banking system, and that would suggest something under $1 trillion, I think, would be
$1 trillion?
Or less, yes.
Okay, of course, that would be very unprecedented. During the crisis that Paul Volcker had to deal with from 79 to 82, it was considered, a major problem. The inflation got out of hand at 15%, and he had to come in and do something. And I guess the question is, how much did he have to shrink the balance sheet during those 3 years?
Well, not very much. He was focused on money growth in particular. So he wasn't clearly in a situation where we are now, where these large unused balances. I mean, I would point out that he was focused on M1 and M2 growth. M1 and M2 are not doing anything now. They're very flat. It's just the base, as you point out.
Well, during that time, which was considered very tight money, the monetary base was still growing. During those 3 years, the monetary base grew 31%. So my suggestion is it might not be so easy, to cut back, because even in the midst of an inflationary crisis like that, because maybe in 6 months or a year from now, when you decide to do something, maybe there will be an increase in M1 and M2, and then it will be a different ballgame when you're dealing with this.
In this interview, Ron Paul was asking some very specific questions to Bernanke back in the day about M1 and M2, and also about the balance sheet. And I think the interesting thing here, I feel he was being a bit deceiving, or at least jawboning the market, telling everybody what they wanted to hear at the time, which was they were going to shrink the balance sheet back below $1 trillion. It had expanded up, as you know, up almost to $4 trillion. And Ron Paul said that would be unprecedented to see the balance sheet shrink at that level. And then he asked a question about Paul Volcker when he was dealing with this 79 to 82 crisis, how much he shrunk the balance sheet at that time. And Bernanke made it clear that he was focused on M1 and M2. At that time, I can tell you that every week the money supply used to come out on Thursday, and Fridays were crazy, because that's what everybody watched, whether M1, M2 were up or down. That was the focus of the markets, somewhat like unemployment is now. But this was the focus at the time. And Bernanke made a comment I thought was interesting, is that M1 and M2 were flat. And I'm going to show you in charts here in a minute. Before I go into the technicals tonight, I want to review this, because this is the moment in time that the Fed is going to become very important. And when Bernanke was talking about M1 and M2 not expanding, I'm going to show you the current environment. M1, M2 are off the map, primarily M1, and then also going to show you the balance sheet. They never flattened the balance sheet at all back in 2010. We know this. It just continued to grow until the point where it's at $8 trillion. So the point of me showing you this clip tonight and talking about this is really wanting to demonstrate what the Fed is going through right now is going to be very difficult to unwind. They've actually painted themselves in a corner, in my opinion, and this is going to be interesting to see how it plays out. Now, the weakness in the market is playing into the 10-year, causing some downtick in interest rates. We'll see how far that goes. The final thing that I want to just mention before we get into the balance sheets is that our database actually downticked quite a bit. We had almost 3,000 sell signals now. That's 3 days in a row. We've had about 3,000 sell signals, only 119 buy signals on our short-term database. We've gotten down to 36% bullish. This suggests we're in a full liquidation mode. I'll talk about this more as we go through the video tonight. The intermediate models did not get the selling I thought they would see. We actually stayed well above the 70% level. Go through all the details here in a minute. Let's go ahead and review some of this information on the Fed, and then we'll get into our typical flow going through the database and all the markets I usually cover. As I go through a quick review of the money supply, I want to flash back. I want to go back to the period of time that was discussed in the video between 1979 and 1983. You can see the red line here is M1, M2. They were very flat. They started to expand as we came into that period. We go forward and we look at the 2016 to the current. As you'll see here, even though M1 and M2 tracking was discontinued, there is some metrics here to look at. All of a sudden we see all of these metrics just skyrocket up 300% of their normal. Now let's take a look at the balance sheet, and this is exactly what I want to point out here, is that the inflationary pressures that are out there are going to continue. As we look at the balance sheet, as everyone knows, we've expanded up to $8 trillion. But this is going back to that 2010 level where Bernanke said they were going to collapse the balance sheet back into $1 trillion. That never happened. We went sideways. And in fact, between 2016 right into 2019, we did see a contraction of the Fed's balance sheet. That was a big discussion at the time. There was a lot of deflationary conversation going on in the markets at that time. Of course, as we came into 2020 and all of the stimulus and all of the bailouts that happened from the Fed, now we've seen this thing expand out to 8 trillion, and this is just catastrophic for the long term. I believe they will expand this to probably 10, maybe 12 trillion before they're done. This expansion is not over by any means. I do believe that these metrics are going to be the things to watch and definitely start to demonstrate that the inflationary pressures are not transitory. Before getting into the database review, I do want to make a special offer in this video tonight. I'm offering our professional platform entire suite, which encompasses WaveTech, Portfolio Expert, Market Grid, everything that we do, including stock screens, all types of fundamentals, for a reduced price of $100 per month. Normally we charge $297. It will be $197 for the first quarter. I strongly suggest you consider this, and the reason for that is I think things are going to be very challenging in the next couple quarters. We discuss all the time about stop trading like an amateur and start investing like a pro, and this is what the pros use. Many folks pay as much as $12,000 to $15,000 per year for this platform. The institutional clients that redistribute our offerings on ETFs or mutual funds or hedge funds actually have to pay a percentage of the money under management. This is quite the deal from a individual levels. Go to kindlereport.com/portfolio expert, no E in the expert, and that will bring up a review and how to get signed up. Thanks for listening. As we get into the database tonight, we're looking at the intermediate database is at 72.17. It downticked about 3%, is all held very firm. Going over to the short-term database, substantial amount of selling coming in. We did see 2,954 sell signals, 119 buy signals. The percent bullish downticked to 36.10. We did see quite a bit of sells on the intermediates. There was roughly 1,550 sell signals with about 318 buy signals, so there was a negative rotation there. As I said, we downticked about 3%. But what's happening here is because the short-term database has dropped below the 42% level, this suggests we will be in full liquidation mode. There's another 15-20% of the database that's likely to be sold or liquidated. What this means, a substantial amount of trends are failing. Right now there's 5,923 symbols long out of 16,400. This number is likely to drop below 3,000 symbols in trend mode. As we begin with the S&P futures, we are down 625. They were up they were down substantially lower, about 20 handles, so they've rallied back substantially. We look at the market grid for today, S2 41.25, the low 41.26. So we printed an S2, R1 41.67. That's likely to be the high of the session. We could extend back to 41.82, but it does look like an R1 S2 for the day. We're seeing the PPMs actually roll over across the board, so this is a bit negative, but as I mentioned in Friday's video, I thought we would trade down to potentially around 40.70, maybe 40.50 in this pattern. Go to the SPX, we did see STX buy signal. 41.8703 was STX number. We closed at 41.66. That suggests we should rally back toward 41.76, possibility of 41.87 in this pattern. We should go sideways for a couple of days. The PPMs have rolled over pretty substantially. It's not a super negative pattern, but we did close under all three averages. Everything turning down suggests we're likely to see some lower prices after maybe 1 or 2 days of a sideways range. We should move down to some of the elements that I will discuss here in the weekly charts. The weekly chart also got a STX buy signal. 41.95 was STX. It closed 41.66. That suggests there would be some sideways pattern. Now, the numbers for today on the here is for a 41.82 would be R1 for this week, and then S1, S2 41.33, which we'll see if we can meet that. The futures have done that overnight, but the cash has not. And you can see the extreme for the week is right at 4,100, 40.99. The key thing to watch for is that 10-period moving average, which is at 41.95. It is actually flat, trying to turn negative, and if we can't get back above 4,200 this week, we will likely see the market move down toward the medium average or the 21-period moving average at 40.49. That number is rising at about 15 handles per week, so that's around that 40.70, 40.65 would be the extreme. We look at the market grid for the week, the extreme once again is right at that 4,100 level. Next market that I'll cover is the NASDAQ. The NASDAQ continues to look pretty good. It remains above the 10-period moving average, so it is the leader in the pattern right now. As I mentioned in the opening comments last week, the Russell was down 4.3 with the NASDAQ only down 0.3. So it was basically flat on the week. But as we come into today, so far we've seen it trade just above R1, looking for S1, R2 for the range for today. The PPMs are all still positive, so it's much different pattern. So we're not in this extreme rollover mode. There's still some numbers on this range that are going to have to be closed under. 13,390 is one of those. If we close under that, then we would look toward the S3 STX number. We'll see how this thing trades over the next couple of days. But PPMs are positive, but neutral. They're below their first and second derivative on PPM 1. The final market I'll cover tonight is gold. Gold got pummeled last week primarily to the strength in the Dow. The Dow continues to remain above the 92 handle. We're definitely likely to see this thing continue to move up toward 92.50, 92.75. Back to the gold, what I'm expecting to see here is a sideways pattern set up. You can see the market grid here for today. The low so far today has been just above the S1 number, 1756, R1, 1781. Traded right to that. Expectation is to move back above 1800 over the next day or so, but I don't see any real uptrend forming from here. In fact, the 10-period moving average will supply quite a bit of resistance around the 1820, 1825 level over the next couple sessions. Now look at the weekly chart. The weekly chart had been quite bullish, setting up this right shoulder, and it still is. But as we look at the market grid for the week, 1751 is S1. I mentioned that 1776 is very substantial support. We're back above that level. From a weekly viewpoint, we should see an S1, at least an R2. I don't think we'll get as high as R3, but look for this market to stabilize in here over the next several days. This will complete the video. Thanks for watching. We'll talk to you tomorrow night. Hey folks, if you enjoyed this content, make sure you subscribe, hit that like button and the notification bell so you'll know when I do these videos.